Welcome to This Week in Money. I'm Jim Goddard. Today, CIBC Wood Gundy's Ross Clark will run down the action on the markets the past week. Author of the book When the Bubble Bursts, Surviving the Canadian Real Estate Crash, Hilliard MacBeth, comments on the stiffer standards for uninsured mortgages and the impact that might have on house prices. Editor of the blog Juggling Dynamite, Danielle also weighs in on that rule. She also talks about how billionaires have damaged democracy in their efforts to pile up even more cash at the expense of regular folks. Plus, at the end of the show, we'll have company showcase updates from American Manganese CEO Larry Reaugh and Blind Creek President Brian Fowler. We'll talk to Ross Clark right after this.
Lotus Ventures Inc. is a BC-based medical marijuana company poised to launch into the rapidly evolving cannabis sector. Lotus is in the final review stage of the Health Canada approvals to become a licensed producer, having arranged facility financing of up to $12 million, plus building permits for its prototype indoor production facility. Shares trade under the symbol J on the Canadian Securities Exchange. Visit our website at lotusventures.ca.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark. He's an investment advisor at CIBC Wood Gundy in Vancouver. Welcome back to the show, Ross.
Pleasure to be with you, Jim.
The U.S. equity markets seem to set a new record high every week. Has this week been any different?
Well, clearly this week wasn't different. If you'd been talking to us on Thursday morning, there was would have been some doubt in people's minds. The market took a hit on the first thing, probably down 100 points on the Dow on Thursday morning, shook that off, and then on late Thursday, the Senate came up with a budget resolution to try and help the U.S. towards their tax reform, and that one was enough of a spark underneath to get us going again. So here we are. Pretty much record highs across the board. You're getting strength also in Asia, the Japanese market doing exceptionally well. And it's just one of those times when momentum is working. And, we look back at the type of momentum moves we've had in the past. This is reminiscent of what we saw in Shanghai 2 years ago running to the top, or in the silver market going into 2011. Or more even actually like the dot-com era, 1995 through 2000, when the markets have been in a consolidation phase. And if we look at the big picture here in New York, we broke out in 2015 out of a long consolidation dating back to all the way actually to 2000 or 2007, both of those highs. Then we consolidated up until the last few months, and now we've started to move again. So these series of breakouts out of consistently shorter periods of consolidation are exactly the type of thing that we saw in the NASDAQ back in the 1990 stretch. So at this point, if we were to look at those correlations, which is what I like to do, I would suspect that this is sort of like NASDAQ of 1999, November of 99, where momentum is just building up towards year-end, carried us through right until March of that year. And that's the way this one looks as though it's unwinding. So I've got some work that I've done that people might be have some interest in that we can send along to them next week. And as I say, momentum is there for now, and I think it'll be a while before it's run its course.
People have said the Dow is in bubble territory, but we have no idea when that bubble might burst.
Well, exactly. I mean, I've got right now, we take a look for overbought conditions and clearly an overbought really just means something is very, very strong. That's all. It's really, you shouldn't think of it as being overbought and can't go further. It's overbought for a reason. And in this case, we take a look at how, U.S. equity market from about March through the summer, although it was grinding to new highs, if you looked at it on an international basis, if you priced it against the dollar index or against the euro or against the yen, it actually was in just a consistent downtrend, small downward channel right through the end of the summer. And then in this last 3 or 4 weeks, what is of note here is that the U.S. dollar bottomed, and that had been one reason that it was going, the markets were rallying in terms of U.S. funds. But when the U.S. dollar bottomed, it has turned, and it's got a nice little head and shoulders base in it right now, dating back to August. But as that has turned, the equity markets, when you price them in these other currencies, the U.S. equity markets have actually started to break out in the latter part of September, about the 15th to the 20th. They broke out of those downward channels they've been in. So the U.S. equity market did have a correction this year, but it wasn't against U.S. dollars. It was against the rest of the world. And at this point, you're seeing all this strength in the U.S. market coupled with a strong dollar. So this is very indicative of some of the other big bull markets. You take a look at the 1920s. 1927 to 1929, it was all a U.S. equity market run because the European markets topped out in 1927. The money came over to North America, and you got that great run into 29. So this has got that same style happening to it. And if we look at then what else is happening relative to the dollar, you're seeing that the oil market is having trouble getting through this 52.5 range. It was back under 50 at one point this week, closed above that. But if it starts to move below 50, I think that becomes a catalyst to the downside. The gold market, which we looked at through the summer with the high commitment of traders numbers, making it vulnerable, had its initial break a couple of weeks ago, bounced back into last week, and now it looks as though it's starting its next leg down. And ideally, that would lead us into the normal seasonal low as we get out into December, possibly early January, with some strength in the U.S. dollar to help keep it under pressure.
Ross, thank you so much for your update.
Always nice to be with you, Jim.
My guest has been Ross Clark. He's an investment advisor at CIBC Wood Gundy, Vancouver. If you have any questions for Ross, you can send them to chartworks@gmail.com. Coming up, Hilliard MacBeth, next on This Week in Money.
Always consult your investment professional before making any investment decision.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO on the TSX Venture Exchange. Rainy Mountain's Brunswick property is located in the Rideout Shear Zone in Ontario, with grab samples running as high as 32 grams per ton gold. A follow-up drill program to test the numerous targets located by recent groundwork will commence later this year. Please visit our website at rmroyalty.com.
AMY.V Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, AMY.V's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Hilliard MacBeth. He's an investment advisor in Edmonton. He's also the author of the book, When the Bubble Burst, Surviving the Canadian Real Estate Crash. Welcome back to the show, Hilliard.
Nice to be with you today.
The federal government has brought in new stress test rules for mortgage buyers. What are those rules and how tough are they?
Well, it's a big deal. You know, they have made some changes, and now they announced this a couple of months ago that they were planning to do this, basically tightening up of the rules. And then they said we'd like to hear from the mortgage broker community, the banking community, everybody, and so they listened to all of the feedback, and the feedback basically was saying, be careful, don't go too far. It could really blow a hole in the housing and mortgage industry in Canada, and so on, like that. In that of course, then you got to figure, well, partly it's personal interest of these people because their jobs are tied to this and everything. However, to everybody's surprise, not only did the government not listen to these concerns that were brought out, but they actually went further than what they were talking about in the initial announcement when they sort of threw this out as a trial balloon. And so basically it's called a stress test, and essentially what they're saying is we want to make sure that these people can afford the mortgages that they take out, not just today, but over the 25-year term of the mortgages. And now this was already in place for CMHC insured mortgages, where people had to buy the insurance and they had to qualify under the tighter rules. But there was a loophole, and the loophole was, up until now, the loophole was if you could get 20% down payment together, scrape it together somehow, go to the payday loan company and borrow it or whatever. And then all of these tighter rules under CMHC did not apply. And of course, so what happened was insured loans under the CMHC and other types of insurance, the growth year over year was like minus 4%. But uninsured loans, which is where this loophole existed, were up 17%. So the government said, oh, wait a minute, we didn't want to create a situation where people were going to the loophole. And of course, what they're doing, in Vancouver or Toronto, almost nobody has 20% down payment for a, $1 million home. That's $200,000. Obviously, they were going and borrowing that as well. So the government correctly, I think, in my opinion, said this is no good. So they decided to apply the stress test that was in the CMHC rule to the non-CMHC. Even if people have 20% or 30% down payment or 40% down payment, they'll have to meet this tougher test before they can. The lender can be allowed to make the loan to them.
Some people have said this new rule could blow a huge hole in the real estate market and cause a recession because so much of Canada's wealth is wrapped up in real estate.
It's true. I mean, it's not just the wealth, because you think about the wealth and people. I mean, I was just talking to them at lunch today at this group, the economics presentation, the City of Edmonton president, and then afterwards we were talking. And the fellow was from Toronto, and he was talking about his friend that was so upset because he sold this house for $1.6 million, and it's a 25-foot lot in Leaside in Toronto. It used to be a working class neighborhood. Got $1.6 million for this 25-foot lot, and he was upset because he thought he was going to get $2 million, of course, but he was too late, and the prices had already fallen, and so he had to take in his mind, it was a $400,000 loss. So of course he was probably counting on that money for retirement and that sort of thing. So there's that, but on top of that, there's the activity. But that doesn't go into GDP. Just buying and selling. Now that guy might take that 1.6 million and spend it into the GDP, but just the transaction itself doesn't go into the GDP. But the big thing is the new younger people. They're buying houses for 4, 5, 600, 700,000. I guess that's what you call a starter home these days. And they're going to the bank with a 20% down payment, some of which money maybe they borrowed or got from mom and dad or whatever. And that could be a new home that's being built by a builder or a new condo that's being built by somebody. That all goes into GDP, and that's a big deal. So if all of a sudden those people can't scrape together the money and qualify for the loan, and that is a huge segment. So it's actually 8% of GDP is in that category. Now that's residential investment only, and that includes new construction of housing and multifamily apartments, that sort of thing, and renovations. Renovations is a big factor as well. So yes, the people are worried about that, and I think they should be worried because this latest change is on top of a bunch of other changes that have been brought in that have had a dampening effect as well. I mentioned the insured mortgages have been actually contracting a little bit recently under the CMHC. So the big change to close this loophole, there's several aspects to it, but the number one factor is they said that the stress test is going to be, you not only have to qualify for the loan that you're getting, but you have to pretend that the loan was 200 basis points or 2 full percentage points more expensive than today's rates, and you have to qualify at that level as well. So, for example, if you got a loan at 3%, and you could qualify for it at 3% with your income, you now have to qualify at 5%, but that's what we thought was going to come in. But then they went even further And they said you have to qualify for that or the higher of another rate, which is the Bank of Canada posted rate, which is the average of all the 5-year term rates. And that number is much higher than what people are able to get now in the market, and it's 4.89%. So that means the posted rate at the Bank of Canada is always going to be the higher rate of the two, and take 200 basis points or 2 full percentage points above that, you've got 6.89%. So now you're asking all these young people to qualify at 6.89%, which is going to be a very high hurdle for them to have to meet, and that's why people are saying this could blow a hole in the housing market in Canada.
Some people have gone as far to say that obviously Mr. Morneau and Mr. Trudeau hate millennials.
Well, it's interesting because I've heard that similar comments, and I have a different take on this, and that is that because now it depends on whether you're like a 35-year-old that already bought a house, or you're a 29 or 28-year-old that's thinking about buying a house with help from the bank of mom and dad. It's actually a huge benefit for the 28 and 29-year-olds because it sounds like it's negative. They have to qualify. They don't actually have to pay that almost 7% rate. They still end up paying the 3 or 4% that they actually get the mortgage at. It's just that they have to be able to prove that they can afford it at the 7% level. And that knocks a whole bunch of buyers out of the market. Obviously, there's a whole bunch of people out there, especially with the economy being a little bit slow, especially in Alberta, but really, most places in Canada, the economy's struggling a little bit. There'll be a lot of families, the young families, that can't qualify for that 7% rate. So that means there's fewer buyers. So if you haven't bought yet, you've got fewer people competing to buy the houses that you might want to buy. And that means house prices have to come down, which is a huge positive for the millennials. It's actually the generation that hits the hardest is probably the baby boomers, the older baby boomers who are trying to sell, like the example I used earlier with the 1.6 million in Leaside. This is a 65 or 70-year-old that's trying to sell, and he's upset because, nobody's going to feel sorry for him because he probably bought for $300,000 20 years ago, and now he's upset that he's only getting 1.6 million when he feels he should have had 2 million. So those people are the ones that are really going to be hurt. The people that are on the buying side, the people that are just moving out of mom and dad's basement or renting and thinking about buying, they're going to be the huge winners in this whole thing. And there aren't that many winners. There's mostly losers, but that group is definitely one of the winners if they haven't bought yet.
Do you think the government anticipated that people who were looking forward to selling at a high price to support their retirement, they might end up having to support those people?
I don't think they thought about that. I think they feel that they have to do something, and it partly goes. They're a little bit worried about the safety of the financial system. So they've got several responsibilities, and some of them are in direct conflict with each other. So they feel like they need to make sure the economy keeps going. Well, this is obviously not in that direction. But they also feel like they need to make sure that the financial industry, led mostly by commercial banks, but also there's a lot of other lenders in the system and alternative lenders, they call them, like Home Capital and Equitable and those ones. They have to make sure that those people don't get into a position where they all fall apart at the same time, because that would be a disaster, similar to the global financial crisis that happened in the U.S. 8 years ago. So they've got these competing worries, and actually this was the regulator of the banking industry that's done this. This is not the Department of Finance or this is not Morneau or any of those people that's deciding this. This is something that the regulators have felt that they needed to do. And one of the things that's unusual about Canada and Canadian regulators is they've been very what's called light touch regulation. They haven't really tried to rein in any of this up until now. This is the first time I guess going back a year when they started making some changes a year ago. And then this one now, the combination of all that is the first time that the regulators in the department called OFSI, Office of Superintendent of Financial Institutions, has actually shown a little bit of force and revealed their teeth a little bit. And up until now, they've been very, very mild. Now, this only applies to federally regulated financial institutions, which are mostly the commercial banks and a few large insurance companies and people like that. It does not apply to your local credit union. So it'll be very interesting to see what happens. Everybody's going to go running to the credit union. And the problem, of course, with credit unions is they're not commercial banks. So they need a deposit, and they need to be a member of the credit union membership before you can get a mortgage loan. So it's a little bit different experience there.
Well, the good thing about credit unions, though, if you lose your job, they're usually pretty flexible on your mortgage payments. Banks are not.
Yeah, the banks are. Now the bank. There's another thing that's happening, which is one of the reasons that regulators have been very light up until now on the banks is they have had very few loan losses for at least 10 or 15, maybe 20 years since the 1990s, the last major crisis in the housing market. And so gradually the regulators have felt, oh, the banks know what they're doing, we won't bother them too much. And but the new rules that are coming in under these international banking regulation rules are quite a bit more stringent. And so there's a problem, there's a conflict potentially between the international rules and the Canadian rules, and it would also affect the banks as well. And maybe some of these changes are sort of trying to get a bit out ahead of that, because they're going to change the way people have to look at the risk of housing in terms of recognizing that there's a chance that people might actually default against their mortgage. And up until now, it's been basically pretty straightforward. If you get defaults, you have to react to it, but if you don't have any defaults, you don't have to worry about it. The new rules means we have to worry about the potential for those people to default, even if they haven't defaulted yet, which is a very different situation. And so this is maybe part of that, where they're going to make sure that the people actually who get mortgages can qualify for them under a bunch of different scenarios, some of which are quite a bit tougher than what the current, it's pretty easy right now to get a loan. Interest rates are really low, and everybody's very comforting and welcoming, and you come in and they say you're approved almost before you ask for the loan. Obviously this is a change. So, the bottom line is it works out to about 21% less. So if somebody was previously able to qualify for a $500,000 loan roughly, they will now qualify for a $400,000 loan. And we don't know. Nobody knows what that is going to happen. But I would think that the housing, my guess is the housing prices will have to come down from 500 to 400 to match what people can qualify for, because the other option would be for them to go and somehow find the extra 100,000 out of their own resources, and not borrow it from the lender. But I just don't think that people have that ability to go and find that extra 100,000. It's not that many people have that sitting around. They might be able to tap into, like, if it's a young person, maybe the relatives might be able to help them out. But I don't think that's what's going to happen. I think the prices will come down to match what the banks are willing to lend, or able to lend under the new rules, I should say.
We'll have more with Hilliard MacBeth next on This Week in Money.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. A work program is planned for our Finland property that contains diamond-bearing kimberlite. Arctic Star trades on the TSX Venture Exchange, symbol ADD, and the Frankfurt Exchange, symbol 82A1. Please visit our website at arcticstar.ca or call us at 604-689-1799.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back to This Week in Money. I'm Jim Goddard. We're speaking with Hilliard MacBeth, author of the book When the Bubble Burst: Surviving the Canadian Real Estate Crash. He's also a portfolio manager and financial advisor in Edmonton. Hilliard, the finance minister has changed the rules now for passive investment income. Can you maybe explain that to us?
Yeah, so the proposal was to tax income inside corporations, and the good example is the professionals like a doctor or a lawyer who they're allowed to incorporate their business. They put their income into that corporation. They take some out to live off of whatever they need to live, but they leave a little bit in there, and it attracts a very low tax rate initially, and then when you take the money out, there's a second level of tax that hits it to get into your personal hands. So what a lot of people do is to avoid that second level of taxation, they leave the money in there and they let it build up. And in some cases, not very many cases, but a few cases of really high income people, it builds up to be quite a large amount. And also with small businesses as well, and medium-sized businesses, the same thing might happen there as well. So the question then becomes, well, how is that money taxed? So if they're able to invest that money, they're not paying any tax on it until they take it out. And then what was discovered was that the people had found a lot of creative ways to get that money out of the corporation without paying that second layer of tax. And one of the now I'm not an expert on this, an accountant would know more, but my understanding is one of the ways that they were able to do it was they were able to make all the members of their family shareholders in the corporation and then pay out the money as a dividend to each of the shareholders of the corporation. So a 5-year-old kid might get some share of the income, and of course their tax rate would be pretty low, if not zero. So it was a way of, it's called sprinkling. They were able to disperse the money out of the corporation without having to pay that extra tax, that layer of tax. And actually, it's not an extra tax. It's just that second level of tax is what would bring it up to the same level as if you were just working for a salary at the same income level. So there was such a big flap over it that they had to back down. Although in the end, my understanding is, and I haven't seen the final results, is it didn't back down that much. They backed down. One of the big concerns was family farms, where people wanted to involve their children in the ownership and the operation of the family farm, and they did back down on that. But it was more of a clarification than a back down, because farmers have always been able to sell their farm, and then as long as they reinvest the money in a new farm within a certain length of time, that they don't pay tax on the sale of that farm. So, but generally the government pretty much stuck to their guns, as I understand it, with a few minor tweaks. So we'll see what people say, but it is something that's really upset a lot of people. We heard a lot about it from clients, especially doctors, who felt that this was unfairly targeting them because they had to pay this extra level of tax.
Did any of them say, well, because of this tax, we're thinking of moving out of Canada, and we don't have a surplus of doctors? I
didn't hear that, but I'm sure that it was said. But the one thing I did hear was that somebody said now this is Alberta, right? So in Alberta, there's something like 3 members of parliament out of something like 30 that are part of the Liberal government, and the other ones are not part of the government. But in one meeting that I heard about, I wasn't there. At the end, one of those 3 people, members of parliament, was presenting this to the group. And one of the persons said, you should dust off your resume and start looking for a new job, because there's no way you're getting reelected next time in Alberta if these changes go through. So it was pretty, I must admit, I'm a little surprised at the reaction. I thought it was initially, perhaps, I thought maybe it was some fairly minor tweaks to the situation, but people really reacted strongly to it. As you say, some of them even threatened to leave Canada. But I think it's, in the bigger picture, it's kind of a sign of the malaise that currently that is kind of around us in Canada now, because like this luncheon I just attended with the speaker about the city of Edmonton, there's a rebound from the recession. We had 2 years back to back of recession in Alberta. Edmonton did a little better than Calgary, because Edmonton has more of a government kind of aspect to the economy. Calgary's mostly all oil and gas. But even Edmonton, the unemployment rate is still 8 or 9%. And not only that, but the jobs that we do have are worse than they used to be. We used to have great full-time jobs. Now we've got a lot of part-time jobs that aren't as lucrative. So there's a feeling that something's not quite right. Maybe it's the threat from the U.S. to tear up NAFTA, which wouldn't probably affect Alberta as much as it would affect Ontario. But generally, there's a feeling that we aren't on the same solid ground as we were when oil prices were $100 a barrel and everything looked very rosy.
Do people in Alberta expect oil to hit $100 or more a barrel again?
I think they did up until a few months ago. I think that the talk you heard was, the thing you heard the most was, we've been through this before, we're going to get through this, but the reality is, now that the oil prices ticked up to $55 and it just leveled off, it didn't keep going, there's a lot of oil in the world. I think you and I have talked about this in the past. And worse than in the world, there's an awful lot of oil in the U.S., and this is the big problem. So he talked today about natural gas, but also I know that shale oil in the U.S. is the biggest, and it's mostly in the western part of Texas on the border with New Mexico, called the Permian Basin, and there's just a huge finds. Now there are some problems with shale oil. You have to frack it, and the production is great for a year or two, and then it drops off dramatically. But literally, the U.S. has become basically equal to Saudi Arabia in the amount of oil that they produce, and that is a problem for us, because Alberta and Canada, mostly coming from Alberta, are the biggest exporter of oil by far. Saudi Arabia only exports about 1 million barrels a day of oil to the U.S. Alberta and Canada in total exports over about 3.5 million barrels a day. So we've been the huge winners in the last 20 years in terms of what the U.S. is buying. And now the U.S. is an exporter of oil and natural gas for the first time, as far as I know, in maybe forever, but certainly for decades. And so now it isn't guaranteed that we'll always just be able to sell as much oil as we want to Alberta. And unfortunately for Alberta, the shale oil that they've got is better oil. It's cleaner. In fact, a lot of it you could just put it right into the tank in your car and burn it without any refining. Although you'd want to refine it, that wouldn't be good for your car, but it would work if you were desperate temporarily. Whereas the kind of heavy oil that we have in northern Alberta requires a lot of upgrading, and plus it's got to be shipped a long way. So for all those reasons, I think people now in Alberta are starting to think that this is more of a long-term thing. And certainly the speaker at lunch today was exactly on that. He said this is a long-term. He was talking about engineering services and professional services and education and healthcare and industries like that, rather than the oil and gas industry as what is going to keep the economy going in Alberta in the future. So we can't expect a big. The oil sands plants, there's only a couple big plants left under construction, and they're both going to be finished within the next 12 months. And then they don't employ nearly as many people once they're up and running. And there won't be new plants built. Now, it takes 14 years, something like that, to build a oil sands plant. And the shale oil that they're finding in Texas, it takes them 8 months to get production and probably 12 or 13 months to get all their money back. So it's just not comparable at all.
And it looks like LNG in BC is pretty well a bust as well.
BC has the same problem that Alberta has, in that there's so much natural gas in the U.S. now. Now it's in a different part it's in the eastern part of the U.S. in the Marcellus Shale in Pennsylvania and New York. It's actually in New York. They haven't even started. The state of New York will not allow them to do drilling for shale gas and fracking. They've prohibited it, as Quebec has. But both Quebec and New York, being neighbors, they both have this shale gas as well. And it's available, and they know it's there, and all they have to do is get a permit to actually do it. In the meantime, Pennsylvania is going crazy on it, and they're loving it, and they're making all kinds of money, and now they've started to export it. So there's two new export terminals. I don't know where they are. They're probably in Louisiana. One of them for sure is in Louisiana. I don't know where the other one is. And they're going to be exporting liquefied natural gas. So that's what we're up against. And unfortunately, in BC, it wasn't just the environmental problems, but they were big. But the other problem was just putting up billions of dollars when there's already quite a few export terminals in Australia and the U.S. and more about to open. It was maybe too risky for the people that would have to put up the money.
What other areas in the energy sector do you see any promise in? Is Alberta going to switch to wind power? It seems pretty windy in some spots.
Well, there are wind terminals in southern Alberta near Lethbridge where it just blows all the time. But the problem is for that part of the world is we just don't have the population, and it's expensive to ship the electricity once you create it. It's too expensive to ship it down. You'd have to send it all the way to California, and that would be a BC hydropower is much closer to go to California than Alberta. So unless somehow magically we get the population, I don't think that's going to happen. One of the things that is I don't think most people would have heard about yet in Alberta is that we have our own shale oil industry in Alberta, and it's the shale in Texas is right up against the Rocky Mountains, and the Rocky Mountains, of course, extend all the way from Mexico all the way up into Canada. And on our eastern slopes of our Rocky Mountains, they also are starting to discover lots of shale oil as well. So although the picture looks kind of gloomy for the heavy bitumen, heavy oil sands in northern Alberta, there actually are smaller projects that are pretty active with shale oil and fracking in Alberta. But again, they have the problem of they're trying to compete with Texas and those kind of places where it's a lot closer to population, and it's also a lot closer to tidewater for shipping. Alberta's going to still be going to do okay. But the days when Alberta was 20% of GDP of Canada with only 11% of the population are probably over, and the investment that's going into Alberta is going to be much less, and it's going to require that other parts of Canada pick up the slack that maybe the Alberta slowdown is created. So hopefully Ontario can rebound if they can get a new agreement with the U.S. and Mexico on the NAFTA, and BC will come bouncing back for some reason. I'm not quite sure what that would be, but something, and it'll all turn around.
Well, we have movies and high tech.
Yeah, high tech is that was mentioned today, and I thought it was a bit of a stretch that Edmonton would become a high tech center. It was mentioned that it didn't really sound convincing, but Vancouver for sure makes sense. There's already a pretty big community of technology in Vancouver, and people. The difference is people actually want to live there, and movies, and there's. Stuff will happen. One of the things they talked about too, and other people have talked about this, is incentives. And the problem with incentives is that if you have low taxes, everybody eventually has low taxes. If Trump gets his tax cuts, then they'll have less low taxes there. We got low taxes in Alberta. You can't really make that an incentive because it's not specific enough. What they used to have, and I don't know if they still have this, but for say like movies, they used to have a special tax break if you made a movie, and that is what attracts people. Just generally saying, oh, we have lower taxes. Well, yeah, these other guys have low taxes too. That doesn't make you special. But if you could say, yes, we have a special tax break for if you make a movie in Vancouver, then that brings people.
Hilliard, thank you so much for chatting with us.
Nice to talk to you again.
My guest has been Hilliard MacBeth, author of the book When the Bubble Burst, Surviving the Canadian Real Estate Crash. His website is themacbethgroup.com. Coming up, Danielle Park next on This Week in Money.
I'm Brian Fowler, president of Blind Creek Resources Limited, listed on the TSX Venture Exchange, ticker symbol BCK. Blind Creek is focused in the Yukon, Northwest Territories, and British Columbia. The company's key property is the Blend Project, one of the largest undeveloped lead zinc silver deposits in Western Canada, plus plans to advance the recently acquired, fully permitted historic engineer gold mine in the Atlan district of northwestern BC. Check us out at blindcreekresources.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Glance Technologies owns and operates Glance Pay, a disruptive mobile payment technology now live in 16 cities in Canada and about to launch in the U.S. With revenues up 664% in the last quarter, Glance Technologies has the potential to be a worldwide leader in an industry projected to grow to $1.3 trillion in 3 years. Glance Technologies stock symbols are GLNFF in the U.S. and GET in Canada. Find out more at glancepay.com.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. I'm Jim Goddard. We're speaking with Danielle Park. She's the editor of the popular blog Juggling Dynamite and also president of Venable Park Investment Council Incorporated. Welcome back to This Week in Money, Danielle.
Thank you, Jim.
Guideline B20 sounds kind of confusing. The federal government's new, tougher rules for uninsured mortgages. Can you maybe explain what it's about and maybe the possible risks to the real estate industry?
Well, actually, it's from the Canadian Office of the Superintendent of Financial Institutions. But the proposal is that starting on January the 1st, they're going to require the stress testing that was previously announced for insured mortgages to come into effect with respect to uninsured mortgages. So these are the people with 20% down, conventional, not looking for CMHC backing. So they're obviously responding to some of the recent reports, warnings out of the IMF and various other bodies internationally who have continued to beat the drum of concern about Canada and our over-levered households, our high debt levels, our extremely overvalued real estate in many areas of the country. And so they are simply saying, listen, it's not in the country or any individual's best interest to be buying these extremely expensive properties with a qualification of interest rates at, the lowest level we've seen in generations. And, there's this obvious concern that if you can only manage to carry the payments you take on at, record low rates, as rates creep up slowly, even if it moves very slowly over time, you're going to continually have pressure on households who are already overextended. So I think, it's just another sort of balloon that will slow down the ascent of real estate and indeed may tip it over in some areas. Sales have been down significantly in the Toronto and Greater Toronto area where I live. And I think that's necessary. It's, been going up so far so fast that it's simply not sustainable. So as we've talked before, Jim, I would say, this was necessary to put the brakes on some of the really rampant risk-taking that's going on and people getting in over their head in too much debt. So it's necessary, but it's also likely to slow the housing market, perhaps put further downward pressure on sales and then eventually prices. And as we've talked about in the past, also have a negative effect on the Canadian economy because we've become so concentrated on dependence in that sector, whether it be in construction, whether it be in services, mortgage lending, the banks. Everyone's really been sort of making their meal out of that particular area for the past few years as the rest of the economy's been weaker. And I think that is, we're going to notice in our going forward in the next year or two that we'll have weaker tax revenue, weaker probably spending, all those things. But we've really earned it, Jim. We've really earned it. We have to go through this mean reversion period here because continuing to push housing prices up on record levels of debt at the extent in the pace we've been doing it is just madness.
Has the Trudeau government changed its mind to go after small business?
I don't think it's changed its mind. I think the usual suspects came in, the accountants and various financial advisors warned that this is all very aggressive by the government, their proposals, and sort of negotiated and talked them back down a bit. They pointed out they may have some unintended consequences of certain activities like passing farms on and whatnot, and so they've, eased it back a bit. But I think as we talked about in the past, Jim, we have to find more tax revenue. We have to cut costs, lower expenses, and find more revenue. That's an ongoing theme. That isn't going away. We've got a demographic problem. We've got a debt problem, and we're going to have to expect that governments are going to be looking for more revenue. So I think consumption tax is probably the best way to go. They certainly should bring that in the United States because, shockingly, they still don't have a consumption tax. And in Canada, of course, we do have, the GST and the HST, but perhaps you're going to see them looking there for a way to increase taxes. The fact is they have to get cash flow off someone, and everyone, is, as I say, most people are having a difficult time. Wages have not kept up nearly with the pace of asset appreciation in things like housing, and debt has come to such a level that, it's quite a slow growth environment. So they're going to continually look for new ways to generate tax. And I think this is just part and parcel. They're going to review the whole business of, who's getting sort of the income sprinkling. They're going to put, they said they're going to put forth a reasonableness test that they put adult family members through to make sure that they're being paid commensurate with their contribution to the business. I think that's all very reasonable. I think that we should expect more scrutiny of some of the loopholes that people have been using, and again, always looking for another place to increase revenue somehow.
Well, consumption taxes, people hate the GST, but compare it to Britain where they pay a VAT of 20%.
Well, you see, the thing about tax is you really have to follow the money, right? And this is the thing, because there's, you can bring in all sorts of, schedules that indicate this rate and that rate, but the reality is with deductions, many people don't pay the posted rate. And there's a income inequality problem, Jim. You may have heard of it. It's worldwide at the moment. And so you have this extreme concentration of wealth in this fraction of the population, and then you have everybody else who's basically struggling. Even what was previously considered middle class incomes are struggling before all the reasons we've already touched on. And so they really do have to figure out, who's able to buy things, who's able to consume. Clearly those are the ones that have the resources to contribute to the taxes. And I think that's just going to be the way it goes.
Bernie Sanders has changed the slogan of the U.S. government. It's no longer for, by, and of the people. It's for, by, and of billionaires. And now even government officials are admitting that?
Well, he's been on that theme for some time, but it is certainly a valid theme. I mean, the tax juggling that's going on, the negotiations around tax reform in the United States, they do need a simpler code. They definitely want a more transparent and more honest system for collecting, a certain rate, because there's so many loopholes and deductions right now and so much complexity. It's a nightmare for people to try and, file their taxes. And then the revenues have been declining. The U.S. has seen declining revenues already, tax revenues, for the past couple of years. And, in that environment, which typically shows a weakening of economic ability and strength, you've got now a tightening of monetary policy and, wanting to stop with the extreme bond purchases that the central bank's been doing. So you really do need to get some tax reform. Now, the problem is, again, that the bulk of the people are not contributing, the people that have the resources, although on a percentage basis they're contributing a great deal, they also take advantage of the most tax shelters and benefits and this sort of thing. So it's not surprising to learn, perhaps, that some of the most wealthy Americans, the Koch brothers being a classic example, have the means now to spend hundreds of millions of dollars in that political process to queer or sway rules in directions that they want them to be, typically that are beneficial for them and their business interests. And, I think it's an absurd system. And I think Sanders was simply pointing out in that clip that this is supposed to be a leading democracy in the world, and the reality is that it's been co-opted to a large degree in recent years in particular by this polarization of income. So I think a very simple fix, and I think we're going to see something like this in various countries around the world. We definitely need a pendulum swing back towards more democratic representation. The ability of people to pay into super PACs and put untold sums anonymously towards swaying policy and lobbying in their favor is simply not democratic, not on any level. And I think that, we're going to see a push towards more transparency about that, and probably definitely need more controls. So the idea that, some person can put in $200 million into a process is ludicrous. It shouldn't be allowed. I think we should go to a system where every individual can put in a maximum of something like $1,500 or $2,000 for an individual, and not every individual would be able to afford that by any means, but it would be much more feasible for many people if they want to make a contribution, and it would take millions and millions of dollars out of budgets for these politicians that really get into a game of who can pay the most and who can sway the most. So once you've gone from the democratic ideals to a system where you need to spend hundreds of millions of dollars to have a shot at an office, you've swung that pendulum far too far to the other side, and there needs to be, again, this mean reversion there as well, where we restore some ideals at least of one person, one vote. And so that clip I put on because I thought it was very interesting with the recent, announcements coming out of the Trump White House. And by the way, this is not just Republicans or Democrats. This, in my view, is a bipartisan problem. It allows people of certain persuasions and personalities, if they have sufficient funds, to have an outrageous impact on the rules and policies of any country. And I think that, when you see Goldman Sachs take over, the Treasury departments take over, representatives from that company take over all the main policy positions, theoretically perhaps coming to lead the Federal Reserve potentially in the next term. That's an example of a corporation that has undue influence. Certainly, the financial sector has incredibly extreme influence and perpetration, frankly, of their members going in and out of these offices. So you really do need to get some rules back on the road. But I thought it was interesting with all the campaign rhetoric about we won't be raising taxes on the middle class. We won't give any breaks to the highest taxpayers and all that. And of course, that was all nonsense because the reforms that are being proposed, of course, are going to indeed give huge tax breaks to the wealthiest people. Trump himself stands to gain, many $1 million in savings if these particular proposals are made law in the United States. And so I thought it was interesting that he finally admitted this week, Steve Mnuchin, hey, sorry, it's going to be really tough to pass legislation without giving wealthy people more tax cuts. And, then they always try and turn to the holding everyone over the barrel. P.S. If you don't do this, the stock market will have a hissy fit and it could really hurt stocks. Well, to which I respond, number one, stocks are due for a thumping just on a cyclical basis here and certainly on a valuation basis. And no matter what wizard is in Wall Street or in Washington, eventually the dam she's going to break because it's just so far past reason already. But also, it's the wealthiest people that have the greatest exposure to stocks. So to try and, turn around and, terrify the rest of the populace into they better, allow wealthy people to have tax cuts or else, really that's an empty threat as well because it's the wealthiest people that stand the most to lose on the asset front.
Danielle, thank you so much for being on This Week in Money.
Hey, thank you.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website, jugglingdynamite.com. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, Hilliard MacBeth, Danielle Park, and thank you for listening. And a reminder, at the end of the show, we'll have company showcase updates with American Manganese CEO Larry Reaugh and Blind Creek President Brian Fowler. If you have any questions for the show, you can email us at info@howstreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Larry Reaugh, the CEO and president of American Manganese. Welcome back to the show, Larry.
Glad to be here, Jim.
What kind of an update do you have from American Manganese for us today?
Well, Well, the first thing I'd like to talk about, and I've got 2 or 3 topics here, or 3 or 4, I should say. First thing I'd like to talk about is this little placement that we announced, and I've had a couple of questions from shareholders at why I'm doing it at this point. And the answer is quite simple. When a shareholder comes to me and wants to put money in the company, and if it's significant enough, then I will do a placement to accommodate him for 2 reasons. One, it helps out the treasury and the company, and it helps out the shareholder. Now, I have learned from experience that you can't, in this business, and you shouldn't, turn down money when it's offered to you. And the example of that goes into my second topic, which was the Black Monday yesterday, which was October the 19th, 30th anniversary. I don't know how many people remember that, but it was a terrible crash in the market. And the Black Monday started out, of course, right away on the Dow Jones, which crashed. And just prior to going into that, I'd like to talk a little bit about the fact that I'd just gotten back about 5 weeks earlier from a trip to London, in which I had been going around talking to various funds about raising some money, or raising awareness was more what I was doing. And one of the companies we talked to was the Royal Bank. And when I got back, they had sent me an offer for $27 million at $9 a share, 3 million shares. And I looked at it, and I knew in the treasury I had about 15 million, which is more than enough to meet my end of going into production on the Samatosum deposit with Minova. And so I didn't want to see the dilution, and I didn't take the money. And then I come into the office on that Monday, the 19th, and the market starts to crash. I mean, there's all of a sudden, it was like my whole screen went, or not the screen, the sound on the screen when you used to hear the ticker going, went quiet. Everything was going no bid, and the Dow crashed down. And it was a stunning day, and I'll never forget it. And but the remarkable thing was that most of the mining stocks were not affected, especially the precious metal stocks. And I had 3 companies out there trading, and they were predominantly in precious metals. The next morning I came in, and they were getting clobbered. I think actually a low trade on Barrick was $1.45. And then I look at my 3 stocks, and bang, they're going right through the floor. And what started out the day is about a $13 to $15 million in value in my portfolio shrunk to about between $2 and $3 million at the end of the day. I was down up over $10 million just like that. Now, when I look at it and I say, oh, yeah, I mean, how could you forget a day like that, right? What it did is it taught me a lesson, because my biggest regret was in not taking the $27 million when it was available, because that would have helped me to build out the company and to add projects to it besides the mining project we had going into production. So I have tried to keep to a formula where if it's got to be at least significant, and I feel $200,000 is significant, then I'm going to take that money. And it just makes good sense to do that. And I learned the hard way. So that's why we take the money. So Black Monday has come and gone. I know there was a lot of perception in the market yesterday and a lot of uneasiness, but that day's passed. And then the Tuesday's passed too, which is our Friday now. So that's one of the topics I wanted to talk about, Jim. The other thing I wanted to talk about is I'm getting questions about, well, now that the permits are going to be filed, shouldn't you be able to release the names of the companies who have NDAs with? Well, the short answer to that is an NDA is still in effect, and no, I can't. And but that said and done, I'd like to point out, why companies are not tripping over themselves to do a deal with me at this moment. If you look at just recently, Volkswagen went out, announced ahead of time, which I guess they wish they hadn't have, that they were going to get a 5-year supply of cobalt, which was significant. I think it was 20,000 plus tons. And they were going to get it at a discount to the cobalt price. Well, that shows you that they were not in touch with the market. Cobalt was in short supply. Nobody was going to give it to you at a discount. Maybe if they'd offered a premium, they may be able to sign up some contracts. But the way they went about it, no. They got none. Because any company that was going to sell their cobalt at a discount in a rising market would be foolish. So, what's that say about the rest of the industry? Kind of tells you the headspace of where the EV manufacturers and the battery manufacturers are. They've been used to picking up the phone, phoning up a cathode supplier, ordering the tons of cobalt, lithium, manganese, nickel, aluminum, whatever they needed to make for their battery chemistry, right off the shelf. Well, certainly for cobalt and soon with lithium, they won't be on the shelf. So, you've got to start thinking about things in the today, not as it's going to continue. It's not going to continue that way. But as long as the mindset's that way, everybody thinks, they got lots of time. They got lots of time. But they don't. And it's going to take some catastrophic event, like a shortage of cobalt shutting down a battery manufacturer's formulation for some of the EV manufacturers not being able to deliver, to bring that to their full attention. But I'd hope that they learn from Volkswagen's experience that now is the time to get out there and start beating the drums. And when I say that, now's the time to be phoning me up, hoping to make a deal. And we're here. Certainly the scrap market out there, which I've talked about before, which is 10% of all the LIB battery manufacturing, which is scrapped in foils, is available to turn back 10% of the cathode materials each year. That's significant. That's a big producer. And, certainly somebody should be trying to tie me up on that. So I expect that things will start to get hotter for the company as we move forward. And, we'll be there. We'll be there to talk to them. And we'll be able to pick and choose our deal, which is what I hope. I've had that opportunity once in my lifetime before, and I hope to have it again. That is really what's going to take. It's going to take to get this market going in the direction we need to start basically getting a partner.
Larry, where is American Manganese traded?
It's traded on the Venture Exchange, TSX Venture Exchange, under the symbol AMY. It's traded in the U.S. under the symbol AMY.ZF. And it's traded in Frankfurt under the symbol 2AM. You can check out all of our stuff on all of our reporting on the research and everything at our website, which is AmericanManganeseInc.com. You can send me an email at LREAUGH@AMYMN.com, or you can just pick up the phone and phone me at 778-574-4444.
Larry, thanks for the update.
You're welcome.
I've been speaking with Larry Reaugh, CEO and President of American Manganese. I'm Jim Goddard. Our conversation took place on October 20th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated. Welcome to Company Showcase, an advertising feature on HowStreet.com.
I'm your host, Jim Goddard. I'm speaking with Brian Fowler, president of Blind Creek. Welcome back to the show, Brian.
Thanks, Jim.
Brian, I see that Blind Creek is in the news again since our last update 2 weeks ago. Yesterday, Blind Creek announced the company has acquired a mining permit and royalty for the company's 100% owned historic Engineer gold mine situated in the northwestern corner of BC. This sounds great for the company. What can you tell us about it?
Good to speak to you again, Jim. Yeah, thanks. Blind Creek has some very big news yesterday, and I'm pleased to have this chance to relate it to your listeners. Yesterday, Blind Creek announced that the company has received an amended Mines Act permit from the Ministry of Energy, Mines and Petroleum Resources, Mines and Mineral Resource Division, that authorizes Blind Creek to conduct exploration, underground mining, and on-site milling activities at our 100% owned historic Engineer gold mine property. This renewable permit is valid until March 31st, 2020. Blind Creek also announced that by way of a separate agreement, the company has acquired the right, title, benefit, and interest of a 1% net smelter royalty on Engineer gold mine by Andean Minerals Limited. In the Engineer mine purchase agreement, the actual purchase price of this royalty was $2 million, but Blind Creek managed to obtain it simply by posting a new reclamation bond with the Ministry of Energy, Mines and Petroleum Resources in the amount of $50,000 to replace the bond previously provided by BC Gold Corp. This is clearly good value for shareholders and the company, Jim. There are now no underlying royalties for the historic Engineer gold mine patented crown grants, previously owned and recently staked Blind Creek mineral claims that comprise the Engineer gold mine property.
Oh, so certainly sound like important milestones for the company. So now Blind Creek is fully permitted for exploration mining and on-site gold production at Engineer gold mine?
Yes, indeed, Jim. The Mines Act permit supplements the water discharge permit the company previously received from the BCM.V in mid-July of this year that authorizes Blind Creek to discharge groundwater from the underground workings of the Engineer gold mine and effluent from the company's 50-ton-per-day gravity separation gold mill into Tagish Lake and the tailings impoundment, respectively, subject to a number of specific requirements. So Blind Creek is now fully permitted to conduct surface and underground exploration, mine dewatering, mining, development, and small-scale gold production at the Engineer gold mine.
Now, Blind Creek conducted an exploration program at Engineer gold mine over the summer. Can you tell us anything about it?
Yes, the company is still waiting for exploration results from geological mapping, sampling, and MMI soil survey targeting additional narrow vein, high grade, and shear-hosted bulk tonnage gold mineralization south of Engineer mine and on the southern Juan claims. We're also awaiting an updated NI 43-1 technical report on the Engineer gold mine property authored by Mr. Darren O'Brien, PGO. Results are expected to provide additional basis for a significant exploration and test mining milling program at Engineer gold mine property in 2018. We expect to have all this in hand by month's end. Another important aspect of Engineer mine has to deal with the recent meeting the company had with the Carcross Tagish First Nations in Carcross this past summer. The Engineer gold mine is situated in the CTFN's traditional territory, and the company was very warmly received by Chief Andy Carville and a number of elders. This meeting provided an excellent opportunity to introduce Blind Creek and our plans for Engineer gold mine to the CTFN and hear firsthand their important issues and concerns when it comes to mineral exploration and development in CTFN territory. We're very, very pleased with that the CTFN is pro-development, and they appreciated Blind Creek's openness and communication initiatives and are very willing to work and partner with us in advancing Engineer Mine through continued exploration towards sustained small-scale gold production.
Brian, it sounds like Blind Creek has really been covering all the bases at Engineer. Can you give us a brief overview of the Engineer project?
Certainly. Blind Creek acquired 100% interest in the Engineer Gold Mine from BC Gold Corp, who are now Pan-Andean Minerals Limited, in February of this year. The historic gold mine produced 18,000 ounces of gold and 9,000 ounces of silver, averaging 39 grams per ton gold and 18 grams per ton silver, respectively, in the 1920s. In a 2011 NI 43-101 technical report, Snowden stated an engineer-named inferred resource, which is open to expansion, of 20,100 ounces of gold grading 1.75 ounces per ton, or 60 grams, in 10,400 tons at a 25 gram per ton gold cutoff. Clearly some high-grade mineralization there. Over the past 10 years, BC Gold spent more than $4.7 million at Engineer, with a focus on property acquisition and consolidation, exploration for additional narrow vein, high-grade and bulk tonnage gold mineralization, test mining, bulk sampling, test milling, and mineral resource development. Since acquiring Engineer Mine, Blind Creek has more than tripled the property size, which is currently over 12,000 hectares, through additional staking. Engineer is a Porter-style epithermal gold-silver system with more than 25 known veins and 2 major shear structures, with excellent exploration potential for additional narrow vein, high-grade, and large bulk tonnage shear-hosted gold deposits. The property overlies more than 8 kilometers of untested second-order shear structures known to host large bodies of hydrothermal breccias with gold and silver mineralization. There's numerous large untested soil geochemistry anomalies on the property, including a 1 kilometer by 500 meters coincidental gold, silver, arsenic, antimony soil magnetic and resistivity anomaly adjacent to the shear zone A structure, where previous drilling by BC Gold defined a 400-meter strike length of mineralized breccia, averaging up to 0.45 grams per ton gold over a width of 35 meters. Blind Creek is positioning to conduct a significant exploration and test mining milling program at Engineer Gold Mine property in 2018.
Now, Brian, in previous interviews, you've emphasized Blind Creek is focused on lead, zinc, silver, and gold-silver project acquisitions, exploration, and development, and that the company's flagship property is the Blend property in north-central Yukon, one of the biggest undeveloped zinc, lead, silver deposits in Western Canada. How does the Engineer Gold Mine fit into the Blind Creek zinc-focused picture?
Very good question, Jim. Blind Creek is very bullish on zinc, and we're committed to exploration and development of quality 100% owned zinc properties such as Blend, as well as our recently acquired AB Mississippi Valley type zinc lead property in Northwest Territories. When it comes to Engineer Gold Mine, I guess simply put, Blind Creek had a unique opportunity to acquire the historic and fully permitted high-grade mine for pennies on the dollar historically spent on this relatively unexplored gold system. When it comes to advancing the Engineer Gold Mine property, Blind Creek has numerous options that we are carefully considering. Whatever path we take, Jim, the company expects a significant exploration and test mining milling program will be conducted there on the property in 2018.
Brian, can you give our listeners a little rundown on your capital structure?
Certainly. Blind Creek has 24.5 million shares issued. 43% of the stock is held by company insiders, and recently the stock's been trading in the 20 to 23 cent range, and our current market cap is about $5.4 million. Another bit of news is Blind Creek will be this week. Blind Creek will be closing our $1 million private placement. There still may be some room, and I encourage any interested investors or listeners to contact the company or check out our website at www.blindcreekresources.com as soon as they can.
Brian, you've given us a pretty good summary on what's happening with the Engineer Gold Mine. Anything else you'd like to leave with our listeners?
Yeah, I guess one last thing, Jim, and I mentioned this last time I spoke with you. Blind Creek will have an investors booth at the upcoming San Francisco Gold and Silver Summit on November 20th and 21st next month. And I invite investors and shareholders to come by and hear the latest and learn more about Blind Creek firsthand at our booth number 513. I also invite listeners to check out the company's website, which I just mentioned, to learn more about who we are and our projects.
And that website again, blindcreekresources.com. Brian, thanks a lot for the update.
Thanks so much, Jim.
We've been speaking with Brian Fowler, president of Blind Creek. I'm Jim Goddard. Our conversation took place on October 17th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.